Welcome to Stock Talk with Nico Criticos. Today we're going to be going through 3 stocks that I will be buying October 2021. The first stock on the list is Vale, and this is a stock I just bought into today. I only bought 75 shares, and because this stock has gone from $22 a share all the way down to $14 a share, okay? And they are the biggest producer of iron ore pellets as well as nickel. And lately this stock has not been doing so good because of China. China's economy is kind of fragile right now. And China I think they import 75% of the iron ore pellets, and that would hurt Vale's business a lot. So that's the case with Vale. Now, if we also look at this, we can see that since the stock has come down so much, I think they pay $1.50 dividend, I want to say, but Yahoo Finance has them at a 19% dividend, but I think what is more accurate is I actually think it's right here, 11% dividend. That's more accurate. So that's the first reason I'm buying this stock, is because the dividend is insane on this. And then if we look at their revenue and income, we can see that it's gradually been increasing, nothing crazy, but it's healthy. Then if we go to their financials, we can see that the one problem here is if we look at their balance sheet, we can see that the equity over the past couple years has been decreasing. It's gone from 44 all the way down to 34. But this past quarter, it has gone up a little bit. It's now at 42. And keep in mind, this isn't a different currency. This is in the Brazilian currency. But nonetheless, this is the equity is still going up. Okay. Now, the other crazy thing about this company is that the PE ratio is super cheap. The forward PE is a 4.1. And that's even over the past year, this is a 4 is cheaper than where it normally trades. Let's see, if we check, the other healthy thing about this company is their return on assets, equity, capital, all of it is super healthy. Return on equity is 45%, and their return on capital, which is the one I like to look at, is 10%. Okay, so overall, those are good numbers. And then I also created this checklist going through all the different things I look for in a company. So if we go through some of these different checkpoints, we can see most of them Vale hits. Okay, if we go on their website, we can see that they not only make things like iron ore pellets, nickel, they also make manganese, they make coal, they make copper, they make all these different things. Okay, so it's not like they're it's not like they depend on one product. And I don't see the mining of these products going away anytime soon. So that's another good sign. Now, based off of 9 Wall Street analysts, they have the low estimate is $15 a share and the high estimate is 27, with an average of $20.94, which would mean nearly a 50% upside. Now, what I've noticed with all the stocks that are going down because of speculation about China potentially crashing the economy, it's normally too overblown. It's normally doesn't happen. It never turns out to be that intense of a situation. So that's why I feel like if we look at the past 5 years, you can see that this stock has traditionally traded right around this $13 to $15 range. Okay, so even if the stock has pretty much took out all the possible any bad news that could happen, the stock has pretty much got pushed down to as far as it can go. Almost. I could see the stock going to 13 or 12, but I think past there, it would have to rebound at some point. So that's stock number 1, Vale. Now we go to stock number 2. Let's see. We're going to go to this one. Next stock on the list is Wynn Resorts. This is another stock that is being pushed down because of talks about China. And let's see. This is the one that my philosophy with this one is normally if you can get it around $100 a share, then it's normally usually under $100 a share is a good price. And then once it gets to about 140, 150, that's when you want to sell. So I kind of started buying this one too early because it was above 100 when I started buying. But I got my cost basis down to $95 a share, which is still, I'm pretty happy with that. It's not as good as the stock was trading at. It's gone from, let's see, if you look a couple months ago, it went from 100 and I want to say 30 something dollars a share, $135 a share, all the way down to $78 a share last week. So, and this is just because Wynn Resorts, they are the best rated casino in Las Vegas, and but their big property is the one in Macau, China, and there's talks about China cracking down on the casinos and the regulations over there. So, you know, there's the possibility that their business gets hurt by that. Okay. But even if that happens, it's not enough to push the valuation down that much. I do believe that Wynn Resorts is still going to be undervalued. And if we look at, because I mean, you have to think this is the high class property on the Las Vegas Strip. And so it's, if you look at some of their properties, you can see that they are really one of a kind. See, they look like this, and it's just something that's hard to replicate. And this is where this is where people who have a lot of money, this is where they go to stay. So the market cap on this company is a $9.6 billion company. Okay, so that's cheap to me. Now, normally this company does pay a dividend as well, but ever since COVID, they cut the dividend. And unfortunately, the past couple of quarters, they still have not been able to report a profit. But once things get back to normal, I'm very confident that they will report a profit. If we look at their financials, we can see that their balance sheet, equity was growing before COVID until last year. They had a negative equity, and then now it's still negative, but it is getting better. Okay, so that's something to keep in mind. This company does have some debt now because they needed to raise money to stay in business. So that's one thing to consider. Now, see, so they have revenue estimates of 46% growth for next year. And then that's 2022 is when I think things will get back to normal and we'll start to see the stock trade at $130, $140 a share, and they'll start reporting a profit again. So that's something to look out for. Now, as far as the PE ratio, it says 147, and that seems very high, but that's just because things are still, how I said, they're not back to normal yet. The next thing I like to look for is, let's look for return on capital. And for this company, it is negative right now, which normally it's not. See, that the numbers are all off on this one. That's why it's hard to judge this. But I mean, if you think about just the fact that this company has super nice properties, they have one of the best properties on the Las Vegas Strip, it's easy to see why the stock will be over $100 a share. And that one, that's just that I feel confident holding this one. Now, next up on the list, my third and final one is going to be one I started buying last week. This one is probably my favorite. This one, if I had to pick one, I'd probably go with this. This is Ollie's Bargain Outlet. And this stock is also one that is, they specialize in, they're like they're a retailer, and they have really cheap things. I've heard that they even will beat out Amazon on their prices. And so that's one good thing about this company. Now, this company was trading at $109 a share a year ago, and now it's $64 a share. And if we go look at the way that the business has been performing, we can see that revenue and profits, so it's only a $4 billion company, not very big, PE ratio of 21. And if we look at how this company's been performing, we can see that revenue and profit is both very healthy. Let's see, let's look at it on this one. So we go over here. So you can see in 2014, they did 637 million of revenue. And 2020, they did 1.8 billion. So the company is growing super fast. Profits have gone from what, back here it was 59 million. 2020, they did 242 million. So let's see, revenue has 3x in the last 7 years. Okay, that's fantastic. Earnings were up 71% last year. And then if we look at the company's financials, so you can see that the company's been growing fast, but the stock chart does not reflect that, especially this giant drop that we see here. So that's why this one I feel is the easiest money on here. Now, if we go to the balance sheet, we can see that equity has been growing. 2018, it was 796 million. And this year it was 1.3 billion, approaching 1.4 billion. Let's see, analysts have them doing 11.5% revenue growth for next year. So it looks like EPS is supposed to be a little bit smaller than it was last year. And the other thing I think you have to think about here is the reason the stock has fallen is because I think a lot of investors are looking at the retail situation as, I think what they're not taking into account is in 2020, that is when everybody went to the stores and was stocking up on stuff. That's why sales were so good. So you have to consider that in the numbers and say, okay, things are not going to be, there's not going to be that huge skyrocketed demand like there was last year, but the company is still growing. Now, if we look at return on invested capital, we can see that's 25%, which is incredibly high. That's also a very healthy sign. And if we look at what some insiders are doing, we can see that not much has happened here. It's been just a little bit of buys and sells, nothing crazy. Hedge funds have increased their positions, and that's why I feel very confident holding this stock. Price target of $84 a share. So yeah, those are my 3 stock picks for October 2021. If I had to go with one stock, it would be Ollies. And with that, I will catch you in the next video.